This is the FM Gold channel of All India Radio. In the program News Analysis, now we bring you a discussion on RBI Monetary Policy Review. The participants are A.K. Bhattacharya, Economic Analyst, and Siddharth Singh, Journalist.
The Reserve Bank of India, at its third bi-monthly monetary policy review, decided to increase the key policy rates by 25 basis points, basically to allay inflationary pressures and the uncertainty in the global world, especially the protectionist policies being initiated by certain big countries. Mr. Bhattacharya, if you could tell the key reasons for RBI hiking key policy rate for the second time.
It is an important policy decision that the RBI has taken this time. Remember that the last policy review, the RBI also raised the repo rate, which is the rate at which Reserve Bank of India lends money to commercial banks, by 25 basis points. While doing that, they had kept their stance neutral. Now, it is important to understand that yes, if you raise the rate but keep the stance neutral, then you are raising hopes that in the next review, you can move either way. You can review it to raise the rate or pause the direction of the rate, in a sense, upward or downward, or reduce it. Now, this time also, they raised the rate, Reserve Bank of India Monetary Policy Committee, but at the same time kept the stance neutral. In other words, they consider that the situation right now is calling for making monetary instruments costlier. At the same time, they want to keep the options open for the next review by which things will be clearer for them to take final view. You asked this question about what are the factors that were responsible for the Reserve Bank of India's Monetary Policy Committee to raise 25 basis points in the repo rate. There were 2 or 3 factors which were on the side of keeping the rates unchanged. There were few factors which pushed the Monetary Policy Committee towards increasing the rate. The oil prices, as you know, has come down a bit in the last few weeks, but they're still remaining at an elevated level. The GST rate have been cut, so which would mean that the product prices and the services prices will come down. Monsoon has been progressing rather well, even though there has been some delay in its spread or its distribution has not been even, but monsoons have been by and large okay. So these are the 3 positive factors which RBI Monetary Policy Committee reviewed and were wondering whether it should actually go for a pause or raise the rate. But on the other hand, it had got quite a few factors that it had to evaluate. Number 1 was the minimum support prices for various crops had been announced, and they saw a steep increase, and the fear is that once these prices are announced and farmers go out in the market and sell their produce, the inflation level might see an increase. The core inflation, which is the inflation rate minus food and energy prices, which has seen an increase and risen to a level of 6%. Now, this is about healthcare and education, and normal product prices have gone up. Now, that was an area of major concern. When core inflation rises, the Monetary Policy Committee is a little more worried because these may not be seasonal, but these may be the underlying factors of why inflation prices are going up. There was the volatility of the financial markets that caused some worry for the Monetary Policy Committee members. There was also the concern about fiscal slippage, because this is the election year, so therefore whether the government manages to stick to its fiscal deficit targets, and also there are many states which are reporting that their revenues may not be good. And finally, 2 points is the household inflation expectations were rising. There was a staggered impact of the house rent assistance that the state governments are giving to various state government employees. That impact will be felt. And finally, the manufacturing firms had in their surveys indicated that their input prices are going up. So all told, what the Reserve Bank of India's Monetary Policy Committee felt was that while the chances of inflation sobering down, staying stable are there, but there are far too many factors that might keep the inflation levels higher. And as they said, that they expect the inflation level to above 4% and almost reach 5% in the first quarter of 2019-20. So keeping the long-term goal in mind, and since monetary policy always has a lag effect, therefore the RBI decided to increase the rate at this point in time so that its lag effect on inflation is showing up in the next 6 months or 9 months, so that the elevated levels of inflation which they are projecting now comes under control.
Experts believe that basically RBI has front-loaded the rate hikes, and now we could be entering in a time period of long pause. Another key point that Governor Urjit Patel made after announcing the monetary policy was he talked about the protectionist regime which is now coming in, the heightened trade war indications that we are getting, especially between US and China. There are some already problems between US and India, and he said this could be the beginning of currency war.
This is a real worry because already the world is going through a protectionist phase. The multilateral trading system is under attack. Bilateralism is on the rise, where one country decides to enter into an arrangement with another country on questions of trade and even investments. The near demise of multilateralism and the rise in protectionism, manner in which the US has increased the tariffs on imports from China and many other countries, has actually triggered a kind of a trade war, as China has also retaliated by raising the tariffs on imports from US. And as a result, what has happened is that the global trade scenario has become little uncertain. Protectionism and trade war, and the logical outcome of this trade war, where tariffs are raised, but countries which are export dependent rely a lot on their exports income, this might see degeneration of the trade war scenario into a currency war, where countries get into a competitive phase of devaluing the currency value of their countries. Now, if that happens, then we cannot actually assess what will be the long-term impact. There will be, of course, the uncertainty. There will be productivity losses. There will be the GDP and investments will suffer. So, therefore, keeping that in mind, I think Reserve Bank of India Governor has rightly alerted the monetary framework and the monetary system here that these are volatile situations, and therefore it will be better to be on the side of caution rather than experimenting with a lower interest rate and look for growth. Yes, growth scenario is tepid in the sense that the growth will not go beyond 7.4% for the current year, and the second half will be actually lower than the first half, the current financial year, and the next year is also the forecast is somewhere in the range of 7+%. This growth may not be enough for the country of India's potential and size, but given the scenario that there so many uncertainties are there, the RBI has adopted a very cautious approach, and I think they are preparing for some uncertain months ahead, particularly in the light that elections are going to be held from the few months from now, and it is important to build your defenses on the monetary policy side so that the fiscal slippages which are feared and which, if they take place, their adverse impact on the overall macroeconomy is limited.
Mr. Bhattacharya, we also saw today the stock market reacting sharply and on increasing fears of trade protectionism coming in a big way. We saw a big fall in the stock market today, whereas we haven't seen that kind of sharp reaction on the currency side, on the rupee, though rupee has appreciated, and the bond yields also we've seen the sobering effect is there. So how do you see these things panning out?
I think 2 or 3 things we need to take note of. One is the US Fed has not raised its rates, and it has postponed any rate decision to September. So that has given the market some relief in terms of the currency. The second thing is that there are talks of US reviewing its sanctions on Iran, which means good news for India's foreign exchange liability on account of oil imports, because it can go ahead and import oil, and oil prices probably will not go north because of these US sanctions to be enforced from November. So these are the 2 factors, in my view, which has actually kept the rupee within that range of $69 and $68. On the stock market side, my sense is that stock markets are going through a very volatile period, and on a daily basis, I would say that we should not draw any lessons whether it is because of the monetary policy stance of the RBI that the stock market has taken a dip. One factor that should be kept in mind is that the bond yields have by and large remained stable after the monetary policy announcement. That is because the central bank has assured a liquidity surplus situation in the market so that there is no spike in the bond yield, which will have an adverse impact on the government's borrowing program and the cost of borrowing, and therefore on the fiscal deficit.
Moving on from here, if I could ask you, take your attention to the micro side. What kind of micro impact can we see on sectors which are highly dependent on retail loans? Because there are fears that this rate hike may force banks to further hike lending rates. And what kind of impact do you see on sectors which are highly dependent on retail loans and which are still, we are seeing some pickup just coming in. So do you see this rate hike having an adverse impact on certain sectors of the Indian economy?
There is no doubt that it will have an impact on some sectors in the economy which are dependent on loans, particularly the housing sector, where the EMIs, equated monthly installments, do play a role. That will definitely be impacted. So the earlier expectation that new house launches may become a reality with a reduced interest rate burden or the equated monthly installments being lower, that will definitely be something that we may not see in some time to come. Also, the consumer goods sector, which also depend to some extent on retail loans, because a lot of the high-end consumer goods, fridges, ACs, they in some markets, in the rural markets particularly, operate on retail loans. They will also be impacted, and that would be some concern because so far the Indian economy was largely fueled by the boom in the consumption area. The consumption was keeping its engine revving. So I do not know what will be the actual impact, only time will tell, but certainly this is something that we need to be watchful about. But remember that output gap in the economy is closing. And if the output gap is closing, therefore, companies in the manufacturing sector, they're investing more and creating more capacities to produce more. And if they produce more, they surely will go into the market, and with the help of GST rate cuts, it might counter the negative influence of a higher interest rate to some extent. So the net result may not be very substantial, and that is a possibility.
Mr. Bhattacharya, do you think this crude oil situation, that uncertainty that has peaked and we are through the worst?
I don't know. The oil market is as volatile as the stock markets. It seems to me that the current consultations that are going on between US and Iran and the current stance that the Organization of Petroleum Exporting Countries has taken on the oil production and raising the oil output by around 600,000 barrels per day, my sense is that oil prices will move in a narrow range of between 70 and 75, or maybe at best, at worst case, it will be maybe 80. If they are closer to 80, there is a cause of concern for an economy of India's size and consumption and import dependence. But if it is hovering at around the $70 mark, then I would say that we can plan with greater certainty over what we need to do to revive and give a boost to our economy.
We hope that going forward, these uncertainties which the RBI has talked about, we get positive news on all these fronts, especially oil prices or trade protectionism. And RBI, since it's very clearly said that they have a neutral stance, so we may see that if things improve, they may not increase the rate, may bring down the rates or maintain status quo. Thank you.
Thank you.
You were listening to a discussion on RBI Monetary Policy Review. The participants were A.K. Bhattacharya, Economic Analyst, and Siddharth, Singh, Journalist. This program was produced and presented by the News Services Division of All India Radio. This program is also available on our website, news.air.nic.in. You may email your opinion about this program at airnsttalks@gmail.com.